Good afternoon, everybody, and welcome to Live Market Analysis, Macro Edition. It's too long to say indices, commodities, foreign exchange and crypto, isn't it? But that's what we're going to be talking about today. My name is Carl Kappeling. I'm the market analyst over here at ThinkMarkets Australia. It's a pleasure to be with you as we go everywhere around the world. Every market is in play today, and maybe we can find some trades in them, but more importantly, we'll try to understand how they are impacting your portfolio. And can I be so bold as to say that never before have we seen so many macro factors coming in to impact your portfolios. Pretty simple format today. Look, I'll talk about some stuff I'm interested in, but mainly it's about the stuff you're interested in. So head to your Zoom window there, type in the index, could be a stock index, could be otherwise, it could be the volatility index, could be the SKEW index. Definitely going to talk about that today. The commodity could be lithium, could be copper, could be gold, could be iron ore. If you're interested, let's talk about it. Foreign exchange, I know the US dollar, Japanese yen, that is a chart I want to talk about today. Looks very good. Or crypto, maybe it's Bitcoin or Ethereum or something else. If you're watching me on any of the streaming services, you'll have the ability to do the same as well. Let us head first to the charts where I am filling, because I need to get over there. Here we go. The NASDAQ, that's where I wanted to start off. And just waiting. Okay. Start typing, everybody. Get your requests in. Let's start with the NASDAQ because it is that key risk on gauge for US equities. A lot of talk about how limited the breadth has been. We can confirm that. Let's have a look, for example, at the NASDAQ 100. So going from the Composite, which there's about 5,000 stocks. In the Composite, we go to the 100. I think it looks largely the same. But then when we go to the equal weight, that's the one that's more important, because now we're saying rather than Apple having a huge weighting, which it does, or Amazon or Google, we're going to give every stock the same weighting in that 100, okay, from number 1 all the way to 100. And we can see it's not looking anywhere near as good. So there's your NASDAQ 100 and your NASDAQ equal weight, okay. While I'm here, let me do the S&P 500 equal weight and the S&P 500. Okay, so you can see again, that actually looks a little bit scary. Whereas this one, the long-term trend was almost about to turn up. So yes, there is a big difference. Market breadth is a problem. Okay, so we've checked that box. In terms of trends, for what it's worth, this is still holding an uptrend. We have had a pullback over the last 3 days as hashtag debt ceiling fears start to take hold of the market. And 1st of June is that a deadline. I wouldn't call it a deadline as such, because if nothing's done by the 2nd of June, it wouldn't mean much more, to be honest. When the US Treasury starts to make noises about not being able to pay for certain things, it could be government wages, perhaps shutting down national parks like they did back in 2011, then we might have some further issues. But it is the key theme, I think, bothering markets at the moment. One of the other big ones is, I think, the deterioration in some of those Chinese equity indices as well. We'll touch on that as we go. If I didn't know anything else and just looked at the pure price action here, I'd say, look, this is still intact. There's nothing to worry about. The short-term trend is fine. The long-term trend is developing and improving, and we've gone from that long-term trend offering dynamic resistance, impedance to upward movement to support of it. The candles don't look so sinister that I need to concern myself too much. Okay, in that last night's candle, we actually saw a really nice lower shadow, and after hours, we've seen Nvidia, one of the stocks we follow very, very closely in our Friday sessions, pop substantially, and will probably drive the NASDAQ higher. Let's hope, at least on the open. Where we'll leave this discussion is tonight's candle, I think, is going to be absolutely crucial. We know we're going to pop on the open because of Nvidia. The question will be where we close. Do we shake off all of that hashtag debt ceiling stuff and just focus on the fact that this trend is developing, on the fact that there's plenty of cash out there, it needs to be applied, the debt ceiling will be worked through. It will be worked through, make no mistake. We won't be, what is this, the 25th of May? We won't be talking about it on the 25th of June, okay? As you can tell the smirk there. We won't be. We shouldn't be. I'll cover myself. We shouldn't be talking about it on the 25th of June. And I think there's great scope here for the FOMO to kick back in. Okay, if we close on the highs, it will confirm that thesis. If we close on the lows tonight, then we've got some bigger problems. And the way they will manifest themselves is potentially through something that resembles this. And I hate it when I start on the wrong color. So let me get to the right color, sorry. And it's going to resemble this. So what we don't want to see is a point of supply coming in below the last point of supply. There's our POS. We know it's a POS now. There's no doubt about it. And we don't want to see this develop and then this form as a pod. Every chance it's going to form as a pod tonight. And if we take out that pod, then something's wrong. Okay. Let us have a look now. We've talked about the equal weight. I just want to quickly head over to the Russell and just show you that it was actually starting to build up a little. It was actually starting to test some of those upper zones, and we can see again another big risk on gauge in there in the US. Also with a double shadow, and then the pushback last night is not great. And while we're covering the US stock indices, let us head to the banking ones, because we're always attentive as to whether these are starting to rear their ugly heads again. They've been out of the headlines for the last week and a half due to the debt ceiling. Something worse has taken their place, and they're actually okay. So that's encouraging. That's not bad. Okay. Let's look at the VIX index. It's had a 3-4 day run up to 20, which is not particularly concerning. I can keep zooming out there and you'll see in the scheme of things, 20's no big deal. But the one I think we have agreed upon that we will watch more closely, I'm just going to change over here, is the SKEW index. Okay. And we only get a finite point for the SKEW index, so a line chart's the better way to go. And we can see that also is rising and remains at elevated levels around about 135 to 140. Okay, so we're still seeing that hedging behavior, or that far out put option hedging behavior coming in from the big fund managers. Let me just show you one item there, which is Khan's webinar that he's doing tonight about how to use the signal center that we've just added to the client portal, which gives you a bunch of technical analysis signals on foreign exchange and indices and the like. But really why I wanted to come over here and head to our website, market analysis, live webinars, and click the relevant webinar to get to that page. I wanted to head over here and just correct a little bit of a mistake I had when I talked about the SKEW last week. And if you remember, I drew this exact picture off the top of my head, referring back to my derivatives 325 back at UWA over 20 years ago. And I did incorrectly label one item, and just to set the record straight, I pointed to this part of the smile and this part of the smile, and I said that they were out of the money calls, okay, at both ends, and that's not true. At this end, they're out of the money puts, and at this end, they're out of the money calls. And I'm sure that's meaningless to most people, and most people had no idea I made a mistake. But just to set the record straight, yes, they are out of the money, but we've got puts on the left and calls on the right. We're looking at the volatility. Okay, so pre-87, the puts and calls were roughly the same value as you went out of the money in terms of volatility, I should say. It's the same implied volatility. Post-87, after the crash, we saw fund managers start to pay more effectively, pound for pound, dollar for dollar, for puts rather than calls, because they were trying to hedge themselves for another black swan event, as it was 1987. Okay, you can see at the money here, then we go out of the money puts and out of the money calls to prove what I just said to you. Okay, I'm certain meaningless to most people, but for the options aficionados out there, you probably are feeling vindicated in the fact you were screaming at your screen last week as I incorrectly labeled my diagram. Okay, let us head to some of the questions. Hear your view. Mark wants to hear my view on yields, how they can affect our returns as tweeted this week. Thanks. And the yields Mark's referring to, I'm going to start with looking at the US 2s, which we can see continue to move higher. I'm going to head here, sorry, because I have my scratchings. It's a complicated beast, is Amy Broker, trust me, but that's not even where I want it to go. It is here, I promise. I'm going over it and over it and over it, and I know it's there. Oh, it's down here. There we go. They're my scratchings. So sorry, Mike. I just wanted to find those, because you can see I've got the labels on there. So yields continue to move higher. If you look at, if this was a stock chart, we'd be so interested in this, wouldn't we? We'd be fascinated by just the number of white candles coming in. And what we're seeing here is not so much strength in yields. I don't think that even makes any sense. You can't say yields are strong. It's just nonsensical. What we're seeing here is weakness in the 2-year T notes. So the prices of those US Treasury notes, T stands for Treasury, they are falling. And therefore the yields are rising because there's an inverse relationship between, let's call them bond prices and bond yields, and a note is the same as a bond I'm trying to remember, there's even a shorter term one, a bill. There are bills, bonds, and notes, but they're all the same thing conceptually. They're fixed interest, fixed term financial assets, securities. And we have gone from about 3.9%, maybe 3.8-ish, high 3.8s into last night over 4.4, and the Federal Reserve hasn't done anything, and the rhetoric from the Fed's largely been the same. In fact, last night's meeting minutes suggested they're pretty close to a pause, in my opinion. What they say, and I'll check my notes here. You can't see this, but I'll read you some commentary from those Fed minutes last night. Some participants commented that based upon their expectations, progress in returning to inflation of 2% could continue to be unacceptably slow. So the pace of getting there is too slow. So additional policy firming would likely be warranted at future meetings. So some participants said, maybe the rate of disinflation is too slow. We need to keep going. But then we had several participants, and if I'm not mistaken, several is more than some, is it not? Noted that if the economy evolved along the lines of current outlook, so if the economy does what they think it's going to do, then further policy firming after this meeting may not be necessary, and they always hedge themselves by saying may. So I'm going to take that as saying, well, I think we're pretty close to a pause here, and whilst they said debt ceiling is not a factor on their minds, no doubt if we get to the next meeting and that's not resolved, it will be. So why then, if really the rhetoric from the Fed is we're probably close to a pause, interest rates going up? And I think it's just to do with the fact that probabilities for cuts later this year, and I'm going to head back to here and show you the CME BedWatch tool, and what I would need to do also then to have this to make any sense to you is to show you the snapshot from before. And so let me see if I can find one. So if we go here, actually I can't make this appear on the screen just the way OBS works. I'd have to add it as a new, maybe I can. Let's try. It's not the way to do it. Let's try here. Sorry, bear with me 1 second. It's an image. Is it an image? Is it a window capture? Let's go window capture. Let's go add existing. No, maybe create new. Okay. And question and answer. That's not what we want. What is this called? PowerPoint slideshow? No, that's not it. That's not what I want. Photos. There we go. Let's try that. And let's go okay. And let me see if it's added. I don't think it did. No, didn't work. Anyway, I wanted to show you the probabilities from before. So anyway, I'm going to speak to them. So if we go back to the start of May, markets were factoring in a much higher probability of a rate cut at the start of the month. So rate cuts later this year. So they were saying by September, 75% chance of a rate cut. You're not seeing that on screen, but maybe you can compare. So where you're looking in terms of what is on screen, as I said, this is hard work using all of these things. So we're looking here. Okay, so this is the next meeting on the 14th of the 6th, because their dates are back to front. We can see 63% chance, no change, 37% chance hike. Okay, then we get to July, and we're seeing actually, for some reason, they're actually tipping a hike on that one. And then it goes sort of 50-50 there. And then when we're going smaller chances, sorry, we're starting to build here towards an ease. This is the ease column, right? So that we're still 72% chance. And then we're sort of coming to a lock next year. Now, what I wanted to show you, and unfortunately I can't, is the same picture, but from a month ago, okay? Where in that September meeting, we were 75% chance of an ease. So you can see there, we're only 12% on your screen. We were 97% in November, so almost a lock. And now we're only 44%, that's on your screen. And then 100% for December, okay? And now you can see December, you're only 72%. So what the market's doing, and I know that was long-winded and everybody's probably just gone to sleep, right? But I just wanted to show, answer Mark's question, which is why have these rates gone up when nothing's really happened? It's because you can see in those probabilities, it's clear. The market is factoring out rate hikes this year. They're believing the Fed. So if that's the case, if markets had through this period here factored in or were believing at that time that we were going to get cuts by the end of the year, it is not the case through here, and they are factoring in. So we have to get closer to where the current interest rate is, which is around 5%. And the 2 years, look, typically can trade in a range plus or minus, but if we are expecting rates to moderate, somewhere between sort of 40 and 50 basis points would be normal. And we're actually closing in on that. So there's probably a little bit more to go here. Now, what does that mean for stocks? And I'll just head over here back to the Australian experience, which is even more horrific because look at that. If that was a stock, we'd be buying it. It's not a stock, it's the price of money in Australia. The price of money in Australia is getting more expensive. It's getting more expensive in the US as well. So, and I did a Google search. This is a true story. I've got a little bit of cash. I need to park for a little bit of time before I need to use it. So I can't keep it in any particular investment in the market right now because I can't take the risk. That is an equity, and equity is a risk. So I need to park some money for some time, and I checked term deposit rates. And there was a range of them, but I noted 12-month term deposits are up to about 4.65% now, 4.65%. And looking at that, they're probably on their way higher. So it gives you an idea that what we're doing here is we're competing for capital for safe returns with your stock market, which comes back to our indices here, where we've got, say, the ASX 200, which is looking a little bit woeful today. So as those quote-unquote risk-free rates rise, it does put pressure on stocks in terms of a comparative investment, but it also undermines the profitability of stocks. And don't forget that what we're seeing on screen, stock prices have to reflect the future earnings capacity, earnings growth of the companies within these indices. And if I'm able to get more on a term deposit, then the way financial institutions will balance that out is to charge us obviously more on our borrowings, and that affects your company profits, because if borrowing costs go up, that is in the cost line, but it also affects their revenues in that if consumers are paying more, we have less disposable income, we have less to spend, and our revenues go down. So it's a double whammy hit for company profitability. Plus you've got the fact that you get a risk-free rate, a better risk-free rate elsewhere. So this is just trying to help you understand why we watch bond yields so closely, why when I sit down in the morning, it's the first place I go. I don't see, what did the Dow do last night? What did the NASDAQ do last night? Okay, what did yields do last night? What did the price of money do last night? Because that impacts every other asset class on the planet. I'm not sure if I answered your question there, Mark. What we would need to see is, really the Fed would have to confirm a pause. What could turn it around? What could change that picture from this creep higher, this just painful death of 1,000 cuts creep higher that we're seeing, undermining a chance for the next bull market? We need to see the Fed confirm they're on pause. We need to see the debt ceiling sorted out, quick, smart. And we would need to see the market start to reprice in those cuts, because that's what they love. Low interest rates is great for the market. Mark's saying I answered the question. Good. Okay. Let us head, to the streamers, because I want to answer your questions as well. And I've got one from a different Mark. We're going from Mark with a C to Mark with a K. Mark with a K on YouTube. And this Mark would like to talk about the gold price. And if you remember, Mark with a K, that we I think it's we. We all agree, don't we, when I'm talking, and it's only just me talking. We all agree, don't we? We all agree with me that we saw this candle here, and we got a little bit nervous by it, didn't we? Couple of reasons why we got nervous. It's at a major point of supply. I mean, a point of supply you don't muck around with. If you don't believe me, have a look at that chart, right? So we're attentive. I mean, if this was cruising somewhere in here, right? See this big white candle? We're not so worried about big black candles or big upper shadows, right? But when they occur in these zones, plus we're seeing the fingerprints of supply, I believe, in the compression through here, it was just enough for me to say, hey, everybody, I think we need to cool it on gold. Just be careful. And I typed in, go check the tapes. I didn't just type this in 5 minutes ago before we started. I typed in that minus 130 if we close beneath that low. And that low there is $1,998. So hopefully, Mark with a K, that's the way you started thinking about gold, and you took some risk off the table. Maybe you're trading gold. I don't know. Maybe you're trading some of the gold companies. And then I also wrote, I'm pretty sure on the same day, if it closes beneath 1969, we'd take another third off the table. And that brings us to where we are, where we've still got a third. And this is my methodology. Some people hate it. Some people love it. Some people just go, Carl, I never thought of it this way, but you know what? It actually makes so much sense. And I get that finding what to buy and finding what to sell almost becomes the easy part. You've taught me trends, you've taught me price action, you've taught me candlesticks. But the key thing you've taught me is actually how to get in, how to get out, and how much. It's just this methodology of just building the winners, but then being a little bit nervous when the candlesticks require it. Understanding that if I get out flat or get out a small loss, it's better than getting out at a big loss. I can always get back in, even if I have to get back in a little bit higher, okay? But also, the other important thing is this idea of having a bit of skin in the game in line with that long-term trend to give me a little bit of a toe in the water, some incentive to come back, continue to check it and stay on top of things, if anything. I think we're there because the long-term trend is fine, okay? But my grip on maintaining that last 1/3 is becoming increasingly tenuous. And the reason for that is, I don't want to draw too many lines on here, so I have to go delete them later on. And I have to keep this chart fresh because I use it in the media. That's the only thing. The problem is if we start to do this again, so we go POS, and I won't draw all the other POSs, Mark, because you know where they are. There you go, I've just done it. Okay, and we know that in between two POSs, there has to be a pod, and this is how I'm finding these, but then there was a pod here as well. This little pod becomes important now, right? So if we close beneath that pod, and I'll give you the number in a second, that's when that last third comes off the table, in my opinion, okay? And extrapolate that out for your gold companies. But you wouldn't blanket all the gold companies. You still have to look at them on a case-by-case basis, but at least it's giving you a heads up. Oh, I need to be really attentive. I need to... I can't give them so much room. I can't say, oh, well, I'm not going to listen to Carl or Carl's methodology. I'm going to say, stuff that. This is a great stock. I'm going to hang on forever. So that low there, and we talked about on Tuesday, a bunch of gold stocks that people are still holding on to that they should have applied the methodology and got the hell out of. That low there is 1951. Let's round it and call it a close below 1950, and let's give it a little bit of sponge room. Okay, so let's say 1948. Give a couple of bucks. Close beneath 1948, and you're dusting the other third. And I'm just going to write that on screen. It might not be there next time if I have to use this chart in the media. That's the only problem. But let's say close less than. That one close less than 1948 equals minus the final 1/3. Silver looks worse because of the huge species-ending event. And there was somebody that commented, replied to my analysis, might have been on Twitter, and no disrespect to that person at all, and they're entitled to their opinion. I really have no ill feeling at all, so don't get me wrong, but they just said, no, I think you're wrong on silver, Carl. And I take no offense at that at all. Please understand, no offense. But I'm just saying, well, I think if you're a silver bull, you're kind of letting your views on silver and the big macro, because apparently when everything was going to fall to in a heap on the macro, gold and therefore silver as a high beta play was supposed to go, and it hasn't. because you don't always know how the funds are thinking. And these funds do crazy things with their ways of thinking as to what constitutes a good hedge against what the hell's going on. And the big problem, I think, for gold and therefore by extrapolation silver is where we started this conversation on those rates. These things don't have a yield. In fact, you need to pay somebody to sit on top of them, on top of your gold or your silver with a shotgun so somebody doesn't seal it. And therefore, on a relative yield basis, they will struggle. So you could have gone into the last 2 weeks saying, hey, debt ceiling, hashtag debt ceiling, better buy gold, and you got smashed. Okay, so don't place what's happening in between this ear and this ear, right? Don't let that interfere with what happens but in these two things, right? Right? Let these two things control what you do, what you see, not what you think. Mark did ask for silver. Are you a gold and silver bull, Mark? And hopefully I haven't blasphemed too much against them. And again, don't shoot the messenger. I don't hate gold, I don't hate silver. Hey, when they were going up, I was telling you to buy them. Okay, I don't love anything and I don't hate anything. I just call it as I see it. Neil is saying that I hope US dollar drops 20. I don't know what that means, the US dollar drops 20, but I think the US dollar is looking pretty good though. So let us head over here and have a look at some of those US dollar crosses and have a go over time. Not too bad. I'm going to have to finish a little early today, everybody, because I have a media cross coming at 1 o'clock with, I'm not kidding, the Arabic, I think that's how you say it, version of Bloomberg. And I'm going to be, I won't be speaking Arabic, they'll be doing a translation, but I'm going to be talking to the Arabic Bloomberg at 1 o'clock Sydney time. How about that? It's going to be a first for me. I was heading over here and we have copper on screen. I'll come back to it because I said it's going to go to my favorite FX trade at the moment, which is actually down here. And I just think the US dollar versus the Japanese yen looks very strong here. It's just a nice trend, isn't it? And just the lack of downside volatility means the market, I think, is pretty convinced that this is probably going a little bit higher. And I think 142 is the next stop. And I'm not saying that necessarily you're going to jump on this, that's up to you. But if you're trading some of those shorter time frames, maybe that helps you as well in framing some of your thinking on how to trade some of those shorter term trends. I'm talking, 5, 15 minute charts, 1 hour charts, wherever it might be. But I think that's a really, really nice trend. Some of the other ones that popped up during the week, quite literally, some of the crosses against the New Zealand dollar, they got a big boost. So generally when you see big white candles like that, I think you can go with them. So on notice for, say, the Euro New Zealand dollar, and I'm talking about potential longs here. And we saw a similar one there on the sterling versus the US dollar. That probably looks better because it's closer to the top of the range and in a better overall trend. And there's going to be some supply here, but I just think if you're taking a bigger picture view, I think the onus will be back to the long side for that pair. Otherwise, the Australian dollar looks pretty awful. And we saw, it shouldn't look that well. It should look awful on the basis of some of the commodity charts, which I'm going to go to next. So we'll get to copper. But it shouldn't look awful necessarily on those yields because we did see the yields popping up. But Aussie yields have risen just slightly less than the US yields there as well. So US yields popped about 50 basis points over the same time frame. Aussie yields have popped about 40. I'm trying to think of any other ones in there. But if you think of any FX pairs, let me know. We talked about, sorry, I should say that Neil talked about the US dollar index, and that still looks very, very strong. Again, watch the candles, watch for big black candles, any upper shadows, particularly in this 105 range. And we'll see how we go for there. I don't know, I can't even, if you said, hey, Carl, how's the debt ceiling, or how's the US dollar being impacted by the debt ceiling? I don't even know. I honestly couldn't answer that question because there are so many other factors at play right now. I'm not even sure what's making this go up, apart from the obvious, which is that yields are going up. Yields go up, US dollar's got to go up. That's the first thing. And then you go, what about a default? What about a default? Surely that's bad for owning US, risk-free assets. Yeah, it should be, but this is still going up anyway. So again, it's one of those times, and they don't happen very often, but they do happen, I can assure you, where 30 years I've been watching markets very, very closely. It's all I've been obsessed with since I was a teenager, and understanding. My friends were out having fun, doing all the wrong things. I'm studying the 1987 stock market crash. Okay, so I don't always understand what's going on, but hopefully I understand enough times to help you figure out what the hell's going on. Neil is referring to a $31 trillion problem, I'm guessing. Something to do with the debt ceiling there. Okay, Mark with a K wants to go back to commodities. So let's head to commodities now. And Mark with a K wants to start at uranium, and then we'll do the whole suite of them, which still looks fine. I think it's amazingly strong. It has not flinched to the downside. I think starts to speak to the underlying strength, I think, in the term market, the term pricing, so the longer term utilities talking to uranium producers. Okay, so no red flags there. Happy to stay the course. That doesn't mean your uranium stocks are going to go up. And during the week, we talked about some really good looking uranium charts, and they're all down today. And it just shows how hard it is to translate strength here into a winning trade on a uranium stock. Let's go to the back to the AMI broker, and I wanted to talk about some of the base metals. Okay, so let's have a look at aluminium. Let's kick off, and I won't go there. I'm going to go here. So I get the line chart, because in London I get a PM fix only, so we're best with a line chart. And we're just looking at shapes here: short-term downtrend, long-term downtrend. Does anybody listening today feel that this is about to turn around anytime soon and shoot up? And if you don't feel that, then you would have to agree that the outlook for global economic growth going forward is likely to be lower, not higher. Okay, that's what we're seeing here. This is what we're looking for, because again, we're looking for macro. We're trying to see how it relates back to our portfolio. You'd look at that and you'd say the outlook for global growth going forward is going to be rubbish. Okay, not a bit lower, but absolutely terrible. There's Dr. Copper. Dr. Copper is on the table, and there's been a few beeps, but then a long continuous beep, just about. Get the paddles out for Dr. Copper. Iron ore, about to break down again. I've got that chart, but I've also got that chart here, which we can actually go to the candlesticks, because I do get candlesticks for this one, is Shanghai. In fact, if I can remember where my scratchings are, and that's the only problem I have here, ladies and gentlemen, is remembering where my scratchings are. I thought they were there. No, they're not there. They're there. Trust me, believe me, there they are. Okay. Potentially breaking through 690, could head to 593, and of course that will translate into maybe an 85-ish, potentially in the US dollar price. Nickel is the next place I want to go, and I'm going to go here to do it. And look, again, much like copper, the key steelmaking ingredient there, looking in big trouble. And lead actually is probably starting to break down. It's been pretty strong on a comparative basis, as is tin, but starting to roll over as well. Look at the short and long-term trends. And then we get to zinc, which is horrific as well. Okay, is that not your galvanized products there? And the big problem, and let us stay over here, because we're going to go to the next big problem. Again, this is what we do on Thursday. We try and tie the loose ends up, try and tie them together. I think we have to go here now, don't we? Which is the Shanghai exchange, which I know I'm jumping around, but I'm looking for my scratchings. Where my scratchings are here on this one. And you can see how organized I am with my watch list, but then I have to remember where my scratchings are. Okay, so we've seen a substantial and sharp drop from this key supply level at 34.25. Okay, you might think this is so far away from your portfolio, but it's not, I can assure you. And the problem was a couple of things here. It was just actually starting to look good twice. So through here, right, and here, it was looking good. And if I was investing in Chinese companies, I wasn't, but I'd be loading up. So the problem is, I do think you've got a market that is a bit loaded up, and now we're down here and they're losing money. And as we go further down, they're losing more and more money. So you could see that long side spill out, and targets down to here, and that's not good. So now that's the broad market index. If we go to the A50, which is a narrower market, certainly than the Shanghai Composite. But the difference is between the Composite and the A50 is the A50 are the shares that you have to be mainland Chinese people to be able to buy them, whereas the Shanghai Composite is anybody can buy them. Okay, if that was a stock, we'd be shorting the hell out of it. That looks awful, doesn't it? Tell me one good thing about that chart. Look at the candle, black candles, low peaks and troughs, my trend zones. Look how reliable my trend zones are on that. So this is a problem, and I can feel the fear building. I can feel it among you all. 22 people on Zoom. I can't see how many people on YouTube there, but I can see lots of chats. maybe there's 60, 70 people. I can feel your anxiety building as we're looking at some of these charts, because that's not I don't think that's good for Australia when that stuff starts to happen. And I'm going to have to go somewhere else to show you these charts. But let us get to here, indices, and look at the property indices for China. And it's the 000952, otherwise known as the CSI 300. So this is, again, one of those key broad property market gauges here. And you can see that it never looked good. And I've been ignoring this. I haven't shown you this very often because, NASDAQ was going up, things were okay. This wasn't really, I think, on the market's mind. And, something can be bad, but if it's not on the market's mind, it has no impact on prices. I just think, well, it's still bad, but I just think it's going to be on the market's mind. If it's not, I think it's going to be increasingly so. And then we go to the HSMPI, which is the Hang Seng Mainland Properties Index, and that looks horrific as well. So this whole buy the rumor, sell the fact trade, which has been the Chinese reopening, has fizzled. And, those moves back in October, November last year, even January, were just silly, particularly in commodities. But they sold us a big dummy, didn't they? Sent BHP to $50, Rio to 130, whatever it was. Fortescue to 26, along with the iron ore price up to $130 a ton. And we have seen, obviously, a bounce back in the Chinese economy, but it's come mainly in the form of spending on services. And it has not been so much in the form of manufactured goods and then property investment. And we've seen, mortgages continuing to bump along the bottom. We've seen prices bump along the bottom. And we've seen more recent the last few days, more talk about problems with the indebtedness of the Chinese property sector. So I'm not painting a great picture for you today. It is a stark contrast to the one I painted for you last week, where things were actually starting to look good. But hey, unfortunately, that's the markets. And again, don't shoot the messenger. I just call what I see on screen. Let's say copper. We've got the high-grade copper chart, which maybe we'll head to here, because I want to talk about this one specifically because we did talk about shorting this one not that long ago. And I can't remember, was it around here, 381? I know we went to the Think Trader platform, and I'm just going to go to the live account. We should go to the demo because, it doesn't matter, we're all the same. At the end of the day, we went to high-grade copper, and we actually went in here and, went to the planes of showing you how you could even, set up a trade on it. Click on that. Oh, I don't have enough money, so it won't let me do it because I'm in the live account. So demo account. Anyway, I won't bore you with the details on how to set up the trade. Needless to say, we did investigate how to do it. And let's have a quick look then at where this one's at. And I can't see anything here to suggest that we are going to get a bounce anytime soon. Okay, so if you're on that trade, I would stay with it. We're at a key potential demand point. So if we look at this rectangle here, we should expect to see some demand there. Okay, and the fact is we're not. So if you look at how we hit that level, the thud we hit it with this black candle, this tiny candle here is starting to trade today's futures. So don't discount that last one. Last night's candle, that's the black one, that's the important one. And then the next level, if I had to draw it, probably be somewhere around here-ish. And that would be the next target. So given we've hit this with a thud, we haven't really shown any impetus to the upside, I'd continue to hold those trades and be looking for, say, 334 to 324 zone to, I would say, take some profit off the table regardless of the signal. I think if you just get in there, take 1/3 off the table by default, and then see how you go with candles for the rest, watching out for white candles or candles with lower shadows. One thing we must do before we leave today, and that is the most popular, and I can't believe, confirming nobody's asked for it today. Nobody has asked for it. And I'll look at oil for you, Nicola, in a second, is the lithium charts. So let us head to here and go to lithium carbonate first, which is going to be there. And let's go zoom, normal, zoom out, whatever you want to do. The V-shaped recovery continues, watching a very sort of steady, stable range, not range of prices, but steady, stable price action That's not even the right word. Because if we go to actually the daily ranges, so I do get daily ranges from, I've switched data providers on this, right? And I'm starting to get daily ranges from where I just got closes, and I've sort of back adjusted myself to two different data sources to give me a continuous chart, okay? Where I get them from will remain a mystery, but we are seeing clear-cut moves to the upside followed by significant indecision here in the ranges, okay? So I would say we're getting close to a pause here. Still could go either way, but probably more closer to a pause than a continuation at this stage, okay? So that's still good. Nothing to worry about there. And lithium hydroxide prices actually continue to, again, trend higher. Again, a little bit of volatility in the range towards the end. But nothing so sinister in there to suggest that we are about to commence another one of these legs. What I'd be watching for is a flattening out period, and then we need to see which way we go from there, okay? And I'm not even going to try and predict what's happening on that one. I've not changed the screen. Thank you for letting me know there, Haraju. And that's the lithium hydroxide price. I'm so sorry. Lithium hydroxide price, as I said, we want to see at least a period of sideways movement, and then we'll see which way it breaks. And I think that break will be decisive. Lithium carbonate, we're still enjoying the V-shaped bounce, but we are starting to see some volatility come in just in the daily ranges more recently, okay? And that's interesting in itself. As I said, I've switched data providers, one which was giving me a fixed close there, and then one which actually gives me a daily range. I think they're both independently reliable, but I'm going to stick with the new one for the time being. I'm going to head back to here, and again, I know, I'm sorry for mixing up the screens there, but because I can't get everything in one place, I unfortunately have to do this. So we're going to head to crude oil. It's pretty flat, probably about the same as what we looked at last week. We did say that these candles here are all very indicative of demand. Oh, let me draw it there. There's your demand zone. I was trying to grab one of those candles and move it across and point to say that one as well, and maybe copy and paste and say this is okay. So I totally get that the long-term trend and the short-term trend are down, but I don't want to discount this one or count this one out just yet. So I get these. I'm not going for a long, I don't think. We got burned on the last one, but I would not be going for shorts either. Okay, I just don't think that's in the market. We've got OPEC meeting coming up very soon, and they have rattled their saber and said, hey, watch out. They just said, watch out shorts, so I think you don't have to read too much between the lines there. But if they don't do anything, maybe it will then just continue with the downtrend. So honest opinion on that, Nicola, is you can see, I don't need to tell you, it's really stuck in the middle. It's extremely indecisive. We're not seeing a clear cut, winning streak from either the demand side or the supply side on that one. For the people that I know are very interested, and I know they are, let's look at some of the energy commodities. We'd see coke and coal continues to trend lower in line with those lower nickel and iron ore prices. Obviously, we do have a bit of an oversupply of steel at the moment, and steel profit margins amongst Chinese steel companies are still subdued. Not helping there. If we go to coal, continues to trend lower. We've talked many times in these sessions that is a very, very solid trend that I don't think you want to mess with. We tried to mess with this trend and talked about going long last week, and that hasn't worked out. And I think you can hang on for a little bit longer, but if I don't think our stops have been triggered yet, but I think if we were to close beneath say 230, let's say 229 or lower, then I think knock that trade out and take the loss on it. Okay, I don't think you want to muck around too much longer on that one. It hasn't worked out. It was a dipper. It was literally this trade. We talked about it ad nauseum about it is a high risk trade. It is a kamikaze trade, and you have to go into those things fully expecting that if you dip the toe in the water, it may not work out for you every time. And that one hasn't, and I think we're good on those. We talked about gold, we talked about silver. I think we're pretty close, everybody. I have done everybody's requests except for Simon, who's asked for the FTSE 100. Let's head over there and do that now. This will be the last one we'll do today, and we're going to go back up here into our European indices, and that is a very decisive candle last night. And if you're not sure what those candles mean, well, there's one there. I don't know what happened last night in the FTSE. I wouldn't have a clue, but whatever it wasn't good. Tiny redeeming feature, two of them. There's a tiny shadow there, and the long-term trend zone possibly can support. But I would think if we're starting to close sort of down here, we're in big trouble on the FTSE. These big black candles often are species-ending events, and that is not great. Would I be buying that one? No, I wouldn't. There's no signal, no sign, no sign that we should be going into that after such a big black candle. Okay. Would I be shorting it? I just think it's a tough one on the basis that you've got this long-term uptrend, little lower shadow, as I said, but it's more likely to be a short than it is to a long. If you're trading this on the intraday timeframes, then I think that's the way you would be skewing your thinking. Okay, but if we're on a daily chart, you have to admit that you've got a short-term downtrend, you've still got a long-term uptrend, and it's moderately indecisive, let's say, at the very least. Interestingly, just while we're here on these European indices, there's the DAX made a new high, and that's a big gap and run last night. And everything, this is where we're going to finish it, is where we started it. Everything will come down to this close tonight. Okay, we're going to get a pop on Nvidia. How much of that pop do we keep? Does the market view that pop as a sell the rally opportunity, selling into the strength, supplying into some optimism, maybe some short covering? Okay, does that short covering continue to the end, or do we not get short covering? In fact, the shorts, hold their nerve. Okay, the selling into the strength continues into the close. The shorts hold their nerve, and we get a black candle or an upper shadow. It's going to be so important tonight. And what a great place to leave it, ladies and gentlemen. Thank you for joining me today, of course. Let me remind you that we have other webinars you can attend if you like trading ASX shares. Hit me up on Tuesdays at 1 p.m. And if you like trading US stocks, Nvidia, Microsoft, Amazon, Alphabet, some of the stocks we've done very well on recently, among many others. Hit me up on Fridays at 12 p.m. Australian Eastern Standard Time for all of them. Register at www.thinkmarkets.com/au/webinars. If you're not a client of ThinkMarkets, you really should be, because we are the good guys in the Australian broking scene. But hey, we don't just have offices here in Australia. If you're listening to me from anywhere outside of Australia, we've probably got an office near you. We have the best products, both in terms of trading good old-fashioned shares, but your CFDs is our main business. Indices, commodities, foreign exchange, and crypto, market-leading spreads, and commission-free on all of our CFD products. We're an award-winning broker. We are regulated all over the world. We have great platforms, great customer service, and you should hit us up there at www.thinkmarkets.com/au or wherever is better for you. If you're watching any of the streaming services, make sure you hit the thumbs up button to let me know you like what I'm doing, so I'll continue to do more of it. If you would like to stay updated on my latest video updates, too many updates, hit the subscribe button as well. Apart from that, it's been a pleasure chatting with you today. All the best for your trading, investing. Until we catch up again. Bye-bye for now. The disclaimer before we leave says that everything we've discussed today is general in nature, has not taken into account your personal financial circumstances or particular needs. So before acting upon any of this general advice, please consider it carefully or seek the help of a financial professional. The rest of the information in that disclaimer is important. You should read it. And if you have any questions at all about ThinkMarkets or our products and services, head to our website and download our PDS.